Okay, I think we'll make a start now, and if there's any late people coming on, they can join as we go forward. So, Brett, you're there?
I'm here.
Excellent, excellent. So, I suppose to start, just a welcome to this webinar, the Inside Scoop on Mortgages and Property. For those in lockdown 3.0 in Auckland, I hope you're all coping well, and here's to a swift return to normal, even as soon as this weekend maybe. And a thanks to our clients and future clients on this webinar. We know that you'll receive some gems of knowledge from Brett for sure. Just some housekeeping. So all attendees will be muted for the entirety of the webinar, but please do ask questions using the sidebar throughout the session, and we will attempt to get to as many of these at the end. If we do not get to all of them, we can respond via email after the session, and of course you can contact Brett or myself at any time. The webinar will be recorded, so you can watch it at a later date if required. And I think that covers everything. So yeah, just as a little introduction from myself, and then Brett can say a few words about him. I'm Justin Keane, one of the directors at BetterCo Advisory and Accounting. And as many of you may know, we merged at the start of the first lockdown last year, with Cloud Accountants and Next Gen Accounting becoming BetterCo. So it's been a busy year for us, very exciting, with a bigger team, being able to provide more services to our clients. We are an advisory-led accounting firm looking to work closer with our clients to assist them in their businesses and personal lives. And our motto is always to try and reach time, mind, and financial freedom. So that is why we love holding these sessions, to provide more insights than just numbers and tax. So that's a bit about me and us. Brett, do you want to give us a rundown of where you come from?
Yeah, thanks, Justin. Yeah, hi everybody. I'm Brett Wood, mortgage advisor with Loan Market. So I've been a mortgage advisor for coming up 12 years. Been in the mortgage industry for coming up 20 years now. And so yeah, part of Loan Market, which is New Zealand's largest mortgage advice brand, and it's actually a big Australasian brand. So yeah, Loan Market's been in operation for over 25 years now, and it's about 120 advisors around New Zealand, about 500 in Australia. So it's quite a big business. Yeah, that's me.
Excellent, thanks for that, Brett. So yeah, let's just jump into the agenda and what we're going to cover off today. The way this will work is that we'll just work through all of these topics, and Brett will give us a rundown on each of these. So there'll be some updates from the COVID-19 lockdowns, the current lending appetites of the main banks, the new LVR restrictions coming into force, interest rates, where they're at the minute, and where Brett thinks that they may be heading. This will be a good one. Is it still a good time to buy a property in this market? And then some refinancing options, and then at the end we'll cover off the questions. So again, if there are any questions, please use the panel on the webinar to ask those, and we'll try and get to as many of those as we can. Okay, so let's jump straight into it. So updates from the COVID-19 lockdowns, Brett.
Yeah, well, what a year it's been, eh? It's been absolutely crazy. You know, real roller coaster. You know, from the world imploding back in March last year to New Zealand becoming the darling of the world, into new lockdowns like right now. It's just been all over the place. But yeah, when you're looking at the mortgage side of things, you know, the mortgage deferments, they're all coming to an end now, and you know, they were a big help for a lot of people. But as the mortgage deferments are ending, the level of mortgage arrears, so people who are getting behind on their loan payments, they've really jumped up. So that's been quite noticeable. Having said that, the mortgage arrears levels are still lower than pre-COVID times. So that's actually quite interesting and really good.
Mm.
Something that ASB Bank actually came out with last week or the week before is they came out and announced that they will not sell up anyone via mortgagee sale. They won't sell anyone's owner-occupied home at mortgagee sale in 2021, which is a really great initiative. And lots of people in New Zealand are doing really well, but there's pockets of the economy and locations. For example, Queenstown is a classic one, where people are really doing it tough in those places. So them knowing that whatever happens, they're not going to get sold up with their home. That's great stuff. So I'd love to see the other banks follow in that. Yeah. And just a little point there, if you do find yourself struggling and you're getting behind on your mortgage payments and everything, communication's the key. Don't put your head in the sand. Some people do that. That doesn't end up in a good way. So if you're struggling, talk to your bank, talk to your mortgage advisor, and you'd be amazed of the effort that your bank and your advisors will put in to help you avoid troubles. I think the low.
Brett, can I jump in there?
Sure.
So have you assisted with any of your clients just if they get into a bit of trouble, and how do you approach that with both the clients and the banks?
Yeah, over the years, that's come up, and it's so different for everyone's individual circumstance. So it's basically taking the time to find out, why's it happened, what's the outlook, and then we can look at, okay, what equity have you got? Can we just change you onto interest only? It's so different for everyone, but yeah, no one wants anyone struggling and sold up. So, banks and advisors, everything possible to help you out.
Yeah, makes sense.
Yeah. The low interest rates, I think, are really helping with the mortgage arrears levels being so low. And to give you a real life example of this, and I guess this sort of comes back to the question you just asked, Justin. In June last year, we came out of lockdown, and a client of mine gave me a call, and he'd lost his job. So his story was that he had an $800,000 loan mortgage, and sole provider for a family of 4, and that sounds like a pretty scary scenario. But we looked through what his options were, and essentially what we ended up doing is we just changed his loan across to an interest-only payment. Luckily for him, his 4% interest rate was just expiring, and we refixed him for 12 months at 2.5% at that time. And his loan payments on an $800,000 loan they became $380 a week. Now he lives in an area where to rent it would cost him $1,000 plus a week, so that was pretty easy for him. And the other thing that we had done when we initially set up his loan is we'd done it in a way where he was overpaying his loan, and then he had a redraw facility that he could draw out and had that pile of money to help him get through that time. And since that, he's actually started a business, and he's going quite well.
Excellent.
Yeah, good success story in the end from something that was initially quite scary. So yeah, banks were actually really helpful during the initial lockdowns last year with the mortgage deferments, otherwise known as the mortgage holidays, putting people onto interest only, all that kind of stuff. So that really helped out a lot of people. Although they gave very little information to clients around what that actually meant for them, what the impacts were. And it's not because they didn't want to, it's just that they were absolutely swamped with those requests. They were getting hundreds and hundreds of thousands of these requests, and they were just inundated. So the banks were redeploying staff and putting people who'd never dealt with a mortgage before onto doing these deferments and interest-only requests and that sort of thing, and they didn't necessarily know the information to give to clients. So yeah, we were trying to give that information where we could, and initially we were manually calculating the impacts of these things, and it was taking us forever. And so as a group, we came up with a calculator to work it all out. And I know Justin, yourself and some of the other BetterCo directors were working through that with some of your clients, but essentially what that calculator does, and it's still on my website now, what the calculator does is you go through and you choose, okay, I'm going from a principal and interest payment to a deferment or to interest only, or there's a whole bunch of combinations, and then it works out, okay, this is what your balance will be at the end of it, this is what your payment will be at the end of it, and this will be the long-term impact of it. So yeah, if you've been on a deferment and it's just coming off, and you want to, things are going well and you want to get back on track, you could potentially go through that calculator and look at what the long-term impact was, and then adjust things accordingly potentially.
Yeah, that was really important, because the communication that came out that it was a mortgage holiday was quite deceiving, and I think they quickly closed that down, and it was a deferment, and there would be an implication of that holiday, if you like. So no, so these sort of calculators and working with our clients worked really well.
Yeah, absolutely, and as good as they were, the banks will the banks took a cash flow hit from doing the deferments, but it wasn't really an issue for them. But they will make absolute bucket loads out of those, with extra interest costs over many years on a loan. So if you took one, and if you can, try and get back on track.
Yeah, cool. Okay, should we jump to the next slide, Brett?
Yeah, yep.
So the current lending appetites of banks right at this moment, what can you tell us about that?
We're open for business again, Justin. So after during the lockdowns last year, and then shortly after, they were not open for business. They really weren't keen on lending because they thought that everyone was going to have a shocker. But no, they're open for business again. Things are incredibly busy. I've been in the industry for a long time, and I've never seen anything like this. It's absolute carnage out there. So you're looking at long turnaround times, anywhere from 2 to 4 weeks to get a mortgage approved. From time to time, if there's something that's really urgent, we're able to squeeze that through due to relationships we have with lenders. But everything's really clogged up, and still your applications are being looked at in a lot more detail than what they ever were. So that's creating a lot of work on top of the volumes as well. Yeah, one thing that a bank does is that when they're looking at an application is, if you're looking to buy a property, for example, they'll do what's called a desktop valuation on the property, normally either through a system called Velocity or CoreLogic, and they'll see what that desktop valuation comes back like. And what we're finding is that those desktop valuations are coming back much lower than where the market's at. Because they're working on comparable sales in the past to come up with the value, and the last 3 in particular, the values have just absolutely skyrocketed. So the desktop valuations are coming back quite low, and then even if you've got quite a big deposit, more than 20%, quite often banks are coming back and they're saying, okay, well, even though you've got this big deposit, we still want a valuation done, a registered valuation. They're quite expensive, so valuation costs have gone up in the last couple of years. So a registered valuation now might cost you anywhere from $1,700 up to a couple of thousand, depending on the valuer. And we're finding that they're more accurate than the desktop valuations, but the registered valuers, so they're coming around to your home and they're going through it and doing proper inspection. but because they're having to justify their value based on the comparable sales within the last 3 to 6 months, those registered valuations are coming back low as well. So that's causing us a few issues here and there. One really important
that could
point.
be problematic, I'm sure.
Oh, absolutely, and you know, when the market's going absolutely gangbusters, you know, there might be you get a valuation done on the property at 1.2, and then it goes and sells at 1.5. It's you know, it's one of those things. It's a hard thing to cope with. But yeah, a point on valuations is that if you are being asked to get one, or if you think you're going to need one, don't just go out and contact a valuer and order it yourself, because most banks these days are insisting that valuations get ordered via an online system, and that will typically be Velocity or CoreLogic, and in most cases it'll be Velocity. General public doesn't have access to that. It's only banks and mortgage advisors can do that. But yeah, banks have opened up somewhat. So a few examples of what they are doing again, like when the first lockdown happened, if anyone had income coming in from Airbnb, for example, or any short-term rentals, that just went completely out the door. So banks weren't accepting that. So just recently, they have started to accept that short-term Airbnb style income again, which is great. And you know, if you've tried to book a holiday home anytime in the last couple of months, you'll know that the demand for them is huge. It's so yeah, people are doing banks are being a little bit easier on self-employed people, which is great. You know, for a while they thought that anyone who was self-employed was going to be destitute and living on the street. So they're not like that anymore, which is awesome. But yeah, they're still being very, very cautious. You know, and every time there's a new lockdown, they sort of revert back to being more cautious again. There's a few annoying things that are happening out there. To give you an example, there's one main bank where if there's multiple shareholders who aren't married, for example, in a business, if there's a profit figure in the financials, then they won't use the shareholders' share of that profit for the debt servicing calculation. So there's a few strange things happening out there, and bank criteria is changing very, very rapidly, more so than I've ever seen before in the last 20 years. And you know, banks are just responding to a changing market essentially. But what's really important to consider is that if you were told that you could do something last week, that might not be the case this week. So don't assume don't assume anything. Get it in writing, basically, is the mantra.
Does it? Can I jump in there, Brett? Does it help to get sort of letters from clients' accountants just to confirm some of these things, the numbers that are coming through on financial statements and tax returns as well? Does that tend to help? Or I'm finding that we're doing a lot more sort of three-way forecasting and providing future numbers for banks. Do they have a level of comfort when they receive some of those sort of reports?
Yeah, absolutely, and especially from chartered accountants. So that carries a lot of weight. And you know, if you're self-employed and you're just applying for a mortgage at the moment, and you're just applying your March 2020 financial statements, and you're not giving the bank any year-to-date information or any projections or anything like that, then you're potentially not putting yourself in the best position. So the more up-to-date information and forecasting and anything from your accountant that you can provide with your application, absolutely, it carries a lot of weight.
Yeah, it's good.
Hey, something that I am seeing at the moment with how hot the property market is you know, people are being put under a lot of pressure by maybe the real estate agents who's selling a property, or you know, so much competition out there and the banks are taking so long to come back with their approvals is that people are taking risks. They're backing themselves and they're bidding at auction or committing to purchases without having the finance in place. That is a very, very risky thing to be doing at the moment. Yeah, I would certainly not recommend that. And another thing that we're seeing a lot of as well is that people are getting pre-approvals from their bank and thinking, okay, they might have a pre-approval for a loan of $1 million based on a purchase price of 1.5 or whatever. And they're going, okay, I'm sweet, and then they're going and bidding at auction or putting in an unconditional offer at a deadline sale or something like that. But they're not getting the bank to check out the purchase agreement or the auction agreement prior to, and they're not getting the bank to okay the property. So it's really important to remember that the banks approve you as a purchaser, but then they also need to approve the property that they're going to take as security for the loan, and they're really, really picky on what they want. So if you're pre-approved, that's great, but then make sure you work with your bank or your advisor before you're bidding at auction or making an unconditional offer, because there could be anything about that property or the agreement that you're signing that the bank doesn't like. Unconsented work, it may be that the desktop valuation's too low and they need a registered valuation, which could stuff you up. It might be the condition of the property. So that's a really important one to keep in mind.
I've got a couple of questions here, Brett, if I can. So come through. So commercial lending and the appetite with the banks at the minute.
Yeah, hey, it's when the lockdowns happened, the banks got really, really tough on commercial. They have opened up a little bit. Any commercial purchase where it's going to be owner occupied, so your business is actually going to be running from that space, is looked at a bit more favourably. But yeah, it has opened up a little bit, and it's really case by case, depending on where the property is located, what it is, and the nature of the business that's looking to buy it and occupy it. If you're looking to buy a property that typically would house an industry that's struggling, that might be a tough one to get through, for example.
Yeah, gotcha. Yeah, no, that makes sense. And another one here. We're seeing quite a number of DIY developments at the moment, especially around Auckland. I'm not sure about the rest of the country, but again, how are the mainstream banks responding? And is it more a thing for second or third tier lenders? What are you seeing?
Yeah, it's got a little bit easier, but that main bank funding for first time or small investors has really got tight. It's really dried up. And last year, even the second and third tier lending really dried up as well. But it's slightly opening up. Yeah.
I suppose again, it's case by case analysis, isn't it?
Yeah, absolutely. They're going to look at what equity you've got, what your background is, income levels, all sorts of things. Where you look to do that development, what the potential demand would be. There's a lot that they look at.
Yeah, makes sense. Yeah, cool. All right, I think that covers off that slide. So yeah, the next one is the new LVR restrictions coming into force. I think almost every other day there's something in the NZ Herald around LVR restrictions. What can you tell us about these?
Oh yeah, property is very, very political at the moment. That's for sure. So the LVR restrictions are coming back into force, but in reality, on the investment side, they've been here for weeks, and in one case, one bank, months already. So we've been dealing with that for quite some time. So what the LVR restrictions are is that from March, technically you're not going to be able to borrow any more than 70% against an owner-occupied home, and then no more then 20% of a bank's lending can go to those on an owner-occupied side who don't have a 20% deposit. Then from May, on the investment side, it drops down to a maximum 60% lend against the value of an investment property. So in reality, the banks have already moved, and they're already all at 60% maximum for an investment property. Now, the owner-occupied restrictions haven't come in yet, but that's not too far away, and that's going to cause some frustrations, you could say. So, you know, last time the restrictions came in, there was a couple of good non-bank lenders that could still go right up to 80% on an investment property. This time round, one of the main ones that we would have used, they've actually gone down to 60% as well. But there is still you know, one or two good options up at 80% for investment properties with non-bank lenders. Now, it's really important to understand that you can still fund 100% of an investment property if you have enough equity in other properties. So say, for example, you own your own home and you want to buy an investment property, you can lend up to 80% of the value of your owner-occupied home, and then up to 60% on the investment property. So, you know, that may still well work out for you to borrow 100% of a purchase price of an investment. Now,
it's like you structure it right.
Yeah, that's absolutely right. And if you're looking to buy a new build investment property, the rules are a little bit different there. So the LVR restrictions that exempts any new builds. So technically, you can go up to an 80% lend on an investment property if it's a new build. So yeah, that might be an off the plans build, or it could be an existing property that's in the ground and its code of compliance has been issued within the last 6 months, and you also have to be the first purchaser off the developer, is the rule there. Now, ASB Bank is actually, they've taken a pretty hard stance on that, and they will actually, on new builds, they'll only go up to 60% lend on that, whereas the other banks will go up to 80. So that's quite different from them. Like I said, the criteria is changing very, very rapidly. You know, I think, you know, over the last sort of 6 months, we've seen a lot of applications for people buying new build or off the plans investment properties, and they're pretty attractive at the moment because of you know, you only need a 20% deposit on them in most cases, but they also they're brand new, so you know, they should satisfy the criteria under the new Healthy Homes laws. And what we're seeing actually is a lot of the more experienced, bigger property investors are starting to sell off their older investment properties, and they're buying new builds because they're already up to standard homes, and they're having less issues with them.
Yeah, that's interesting.
Yeah. So we might see a few more properties, you know, come on for first-time buyers there as they do that. Yeah, it's really important to like if you're going into an off-the-plans build, you know, they're all good in theory, but you've really got to know what you're doing if you're committing yourself to them. So from a finance point of view, some banks will give you a 12-month approval for an off-the-plans build, and some others will only give you 3 months. So you need to have a clear understanding of that. And you know, if you've got a build that is scheduled to be completed in 8 months' time, for example, you know, most of the time it won't be 8 months. It'll be 10 or it'll be 12 or whatever. They always get pushed out, particularly when we have lockdowns happening. So if your mortgage approval that you've got with your bank that you've relied on and paid a 10% deposit, if that's only for 3 months, every 3 months you're going to have to reapply. And with the bank, criteria changing so quickly, that's a really risky place to be. And also your circumstance could change as well, and banks may not like that. So, hey, I very strongly suggest that you seek some really good quality legal advice if you're looking to sign up to an off the plans build. With a lawyer who's dealt with a lot of those off the plans builds before would be a good idea.
Yeah.
And then also, seek some advice on the finance side as well, because you could really set yourself up for some troubles if you don't get that side right. But going back to the LVR restrictions, values have increased 20% in the last 12 months across the country. So a lot of people who already own a property or two, their properties have come up so much in value that having to come up with a deposit on an investment property may not be an issue for them, but they may need to get valuations done or something like that. But it's going to be a little bit harder for the first home buyers, once these come back in March.
Yeah, no, that's right. No, that's some really good tips and tricks there, and I suppose it's ever evolving as well, isn't it? Sort of, you don't know how long these LVR restrictions are going to be in play, and that sort of leads me into a question that I've got here. So are these likely to be a long-term vehicle now for the Reserve Bank, do you think? Or like last time, will they relax these in time? What's your view around that? I suppose it's a little bit of crystal ball gazing, isn't it?
Yeah, I do think they're going to be with us for a long time, Justin. The first iteration of the LVR restrictions came into play in 2013. So they've already been with us for coming up 8 years. So I don't think they're going anywhere, personally, and I think they'll just be tweaking them as time goes on. That's my thoughts.
Yeah, no, that makes sense. Excellent. So let's jump to, always a hot topic, interest rates. What can you tell us about where they're at currently and where you think they're going to be heading?
Okay, I'll just go and get the crystal ball, Justin. So don't hold me to any of this. If you've ever looked at an economist's interest rate forecast ever since 2008, they've probably got that wrong. It's been even before COVID came along, it's been an incredibly difficult time to try and forecast interest rates. But I'll give it my best go, So I think that we could see some further reductions in the short-term rates, for example, the 12-month fixed rates. And then I think we could see some slight upwards creep in the long-term rates, like maybe your 4 and 5 year rates. And why I say that is that in December last year, the Reserve Bank announced what's called the Funding for Lending program. So basically what they've done is they've set aside $68 billion, which they're going to lend to, they're going to make available to lend to the banks to fund however they want to fund. And considering that most bank lending happens for residential properties, they're probably going to use that. So essentially that facility, it's available for a 3-year period, and banks can draw down on it, and the cost of those funds is set at the official cash rate, which as of today is 0.45%. So when you look at the weighted average cost of where banks get their money across all the different sources, the current weighted average is 1%. So this is a new really cheap line of funding that they can access, and they're just starting to do that. But because it's only available for a 3-year period, they're only going to be funding their short-term rates for it from this facility. So, just in the last couple of weeks, as the banks start to draw down on this funding for lending facility, we have started to see some decreases in the 12-month rates. And now the mainstream banks are sitting at around 2.29 for 1 year fixed, and then we've got a couple even with some ones in it. So I do think that as they continue to draw on that money, we may see some further small reductions in those 1-year rates. Conversely, on the long-term side, so a funding component for those long-term fixed rates, like your 4 and 5 years, comes from what's called wholesale funds, which is basically New Zealand banks borrowing from international banks like American banks and British banks and whatnot. And over the last couple of months, the cost of those funds has been creeping up a little bit. So as the vaccination program is starting to roll out around the world, the financial markets are starting to forecast some better economic conditions in various countries, and so the interest rates are sort of climbing up, or the cost of those funds are climbing up in the anticipation of that. So yeah, the New Zealand banks accessing that international money, the cost has gone up. We haven't seen any increases in those long-term rates at this point, but we could see that. So that's the short-term sort of scenario, Justin. In a longer-term scenario, I do think that we will see low interest rates for quite some time from here. I'm expecting some real rises in rates, maybe late 2022, maybe into 2023, 2024, something like that. It's pretty hard to pick, but the economic impacts of coronavirus around the world are pretty severe, and it's going to be a long time before things are back to normal, I think. Yeah, but if you're looking at what to do with your interest rates at the moment, everyone's circumstances are so different. I think it's worthwhile seeking some advice around it. I think at some point it probably will be a good time to go 5 years at 299, for instance. But when you're looking at that kind of thing,
can you still get that rate for 5 years now?
What's that? Sorry.
Can you still get that 2.99 for a 5-year fixed?
Yeah, you can. Yep, pretty much most banks are offering that. Some you have to negotiate that down, but yeah, we're getting that with every bank that we're working with. But yeah, if you're looking at a long-term fixed rate like that, you got to look at, okay, well, what have I got coming up in my life in the next 5 years? And if I needed to get out of that rate, what would the impact be? And that's the thing in New Zealand. We have a nasty thing called fixed rate break fees, and you can't forecast them, and they can be pretty severe. So you got to be pretty confident to go in with a 5-year fixed rate.
Now, I know every person's situation is different, but what are you finding when people come to buy a house or an investment property? Where's their mindset at the minute for fixing and what term?
Yeah, it's typically been the 1 year, but I am finding people are getting more interested in the longer, and people are starting to ask me about 2 and 3 year fixed rates. On the 2 year and then the 3 year would traditionally be the most popular rates to take in New Zealand. I'm not thinking they're a very good bet right now, because they cost more than the 1 year fixed rates. And then you're locking yourself in, and you're coming out of them potentially right at the time when we're in that where conditions are better and we're seeing rates coming up. So I'm sort of more of the 1 year or 5 year thinking at present myself, and I'm probably swinging more towards the 1 year at 2.99 or maybe even cheaper, and then looking to maybe lock in longer when that comes up for renewal. So if today you're locking in for 12 months, in 10 months time you can be locking in your next fixed rate. So I think that's reasonable.
Yeah, well, that was pretty good crystal ball gazing, Brett. I think you've done fairly well there. We'll hold you to that. We'll ask you in 12 months, shall we?
Yeah. Well, if you ask me tomorrow, I'll tell you something completely different.
Excellent. So this moves us on to, is it still a good time to buy? Interesting.
Yeah. Well, that used to be the $1 million question, but now you could probably call it the multi-million-dollar question in a lot of places in New Zealand. Yeah, it's hard one to answer that one, Justin. Yeah, considering that 11 months ago, the top economic brains in the country were telling us that property values were going to drop by 15%, when in actual fact they've risen by 20. So how do you get that right? It's tricky, but I guess my short answer is that it depends on your personal circumstances. So, you know, trying to time the market is a really difficult thing to do. Again, it's crystal ball gazing. And to give you an example from myself, you know, 3 years ago, I purchased a new investment property. And at the time, I thought that I was buying at the peak of the market, but I wasn't too worried about it because the time was right for me. So it was all good, and the property that I bought, I knew it was going to be a good renter. So I purchased that at $725,000, and the property just in front of it, in worse condition with not as good of a view, just sold for 1.1 the other week.
Wow.
So it turned out it wasn't the top of the market, and yeah, it was fine. I guess the longer answer. Yeah, the longer answer to that question, Justin, is it still a good time to buy? I think we need to look a little bit deeper into the fundamentals of the property market here, and to put it into some sort of perspective. You know, we can compare it where we're at now in the property market to the last significant drop in value that we saw in New Zealand, which is when the global financial crisis, or the GFC, hit in 2008. So, you know, important to note that when the GFC hit, economists and property commentators were picking a 20 to 50% drop in property values in New Zealand. Now they did drop, but nowhere near that. It actually ended up at 10% across the country, and then they rebounded to where they were again pretty quickly. So when you're comparing, you know, the GFC time to now, back when the GFC hit, there was 58,000 houses for sale in New Zealand, and in the January before COVID hit, there was 19,500 houses. And in January 2021, now there's only 15,500. So the actual properties for sale now is down 20% on what we were this time last year.
Right.
And on top of that, there's a lot more people in New Zealand. So back in 2008, there was 4.26 million people, and in New Zealand, and now there's 5.1. So there's an extra 840,000 people in New Zealand competing for a quarter of the properties that were available back then. So the supply side of things is incredibly tight. Yeah, the next thing to consider is interest rates. So back in 2007, coming to 2008, interest rates were 9 and 10%. My 2-year fixed rate was 9.15%. My floating rate was 10.5%. And then they to 7% pretty quickly, and then they got down to 6%, and everyone was freaking out of how low they were. But now we're in the very low 2s and even 1s. So that's doing a few things to the market. So firstly, it's meaning that first home buyers are weighing up the cost of renting versus paying a mortgage, and they're very, very similar. And that's making them very, very keen to get into a property, as if they weren't already. It's also that property investors are finding it easy to find cash flow positive properties. Now, that has always been very, very difficult to find in New Zealand. You know, historically, when rates have been up at 6-8%, you buy an investment property and then you're having to chuck money into it every week just to pay the mortgage. Whereas now, just every investment property that you look at, if your mortgage is on interest only, it's going to pay its way and quite possibly put some money in your back pocket every week. So property investors are super keen. But then, you know, with the interest rate so low, you know, there's a lot of people out there with money who are looking to get some yield on their savings, on their money. So I'm getting a lot of inquiries, Justin, from people that would never ever be calling up mortgage advisors to ask about mortgages. For example,
Interesting.
retirees in their late 60s, early 70s. They've got a multi-million-dollar property that they live in with no mortgage. They've got a couple of rentals already with no debt. They've got a couple of $1,000,000 in the bank, and they're contacting me and they're wanting to know how much they can borrow to buy as many investment properties as they can. The short answer is not much, because they're not working the name of it. But you know, they're keeping their money in a bank on a term deposit. They're eroding their wealth because the interest rate they're getting and the returns are being taxed. You know, it's not even keeping up with inflation. So people are on the hunt for yield. You know, a lot of people have done really well from the share market in the last 10 months, but also a lot of people are really scared of it because they don't want to put a big sum of money into the share market and wake up tomorrow and see 30% of their wealth eroded. So people are really piling into property because of those low rates. You know, another thing to consider, you know, comparing the GFC to now, is that back in 2008, the New Zealand banks they're very reliant on this offshore money. So about 50% of all the mortgage money that the banks lent out back then came from international banks, and a lot of that came from American banks. So the GFC came along and the banks stopped lending to each other, and suddenly the money supply in New Zealand for mortgages just really shrunk. And for a couple of years after that, it was very, very difficult to get any loans approved, and that really tightened up the market and suppressed the demand. So very, very different to now. The banks are flush with funds. There's a lot of money, just people saving it in the bank, even though they're not getting very good returns on it. There's very little reliance on that offshore money now. Hey, the banks are even able to borrow money from the government at very low rates. So they're absolutely flush with funds. They're still being very cautious on their lending, but they're very well funded. You know, immigration has stopped in its track, of course, but we do have Kiwis coming home, and you know, there was a survey of Kiwi expats done last year that suggested that there could be up to 500,000 Kiwis might come home in the next 24 months. Yeah, who knows? You know, once the vaccines come and things get back to normal, they might forget about it all and stay where they are. But you never know. But
but maybe not. But also, there's probably a lot of overseas people that look at New Zealand and how COVID-free we have been for a long period of time, and see that as an attractive place to, you know, to set up their homes in the future. So who knows who might come down to our country?
Yeah, that remains to be seen. But you know, New Zealand's been the rock star for the last 10 months, and you know, I know if I was living somewhere overseas and I saw that you could be watching yacht races and going to music festivals in New Zealand, I'd want to be there.
yeah, that's right. Let's keep touching wood though, because we don't know what's around the corner.
Yeah, that's exactly right. But yeah, I guess just to summarise, you know, if the time's right for you, like if your business is going really well and the outlook for your business is good, if your employment's secure, then I think it's a reasonable time to purchase. You know, if you're looking to buy a property and hold it for a year and make some money on it, good luck to you. But if you're looking for a mid to long term hold, then I think it's a reasonable time.
Yeah, that makes sense. Makes sense. So just to let everyone know, we're probably only a couple of slides away, so probably another there's probably only a couple of questions at the end. I can't see too many coming through. If you've got them, fire them in there and we'll try and get to those. But as I said at the start, we can get back to those questions if we need to. So yeah, it's probably another 10 or 15 minutes to go. So refinancing options as well for people, Brett.
Yeah, well, refinancing to a large extent, Justin, was off the table for a little last year. So, you know, banks were looking at refinance applications with a very tough eye, and they were suspicious of people who wanted to leave their existing bank and change banks. which was quite different to normal. And also, as a mortgage advisor, I wasn't advising that people in the first part of last year look to refinance, because if they did get in trouble, then their existing bank was probably going to be that they had history with, was probably going to be the best option to help them out if they needed assistance. So hey, that's all opening up now, and banks are pretty keen on refinance applications again. They're offering cash incentives and that sort of thing. So depending on the bank, you can look at about 0.6 to 0.7% of the loan amount as a cash incentive to move. So they're definitely opening up to it. A daily inquiry that we would get, geez, I don't know how many times a day, but it's a lot, is, hey, I'm on a 4% interest rate. It's really expensive. 4% rate's expensive these days. It's crazy. And they want to get into a new rate with a 2 in it. And so what we're doing is a break-even analysis. So looking at the cost to get out, the benefits of a new rate, and is it worthwhile? And probably 8 to 9 times out of 10, it's just not worth doing it, is what we're finding. So in most cases, it doesn't stack up unless you are changing banks and you're getting a cash incentive to move, and you can apply that to the whole calculation. And then in a lot of cases, it does make sense to break out of your expensive rate and go for something cheaper. But we're doing all the numbers, so making it very clear for people so they know what it means. The first lockdown, that was a real wake up for, I think, probably most people. In the first 3 weeks of lockdown, I received hundreds and hundreds of panicked phone calls from mortgage holders. Our existing clients, new people we hadn't talked to before. It was really crazy, but since then New Zealand's been actually going really great. Mostly, obviously there's pockets of the economy and locations that haven't, but generally we've been going really well. And but as this lockdown shows, anything can happen at any point, and we're still in a very, very uncertain time. So I just to go off topic a little bit, I think households should have a minimum of 6 months worth of funds available. So that being mortgage payments and your other living costs, and have it easily accessible. So with the low rates at the moment, you can really nail your mortgage and pay it down super quick right now. And I'm finding that a lot of people are doing that, but a few people I'm coming across are doing it in a way that's locking them into really big payments. And I think that's quite a being locked into big payments right now, if you don't need to be, is not a good thing, because anything can happen. So if you're looking at making some headway on your mortgage and paying it down quickly, there is banks out there where you can set your mortgage up in a way where you can have a really long loan term. So you could have like a 30-year loan term, which is the longest you can have here in New Zealand. But you can set it up in a way where you can make much, much bigger payments to get it paid off quickly and take advantage of the low interest rates. And then you can also set it up where anything that you've overpaid, you can redraw again if you find yourself, we're in a new lockdown and your business is struggling, or you've lost your job or whatever. And then you can link in multiple bank accounts to decrease your interest costs and that sort of thing. So, it's absolutely worth looking around at the market and looking at your personal circumstance, what you're looking to achieve, and looking at what bank might be able to best help you to do that. But again, everyone's situation is so different. I think it's worth reviewing your mortgage every year or two, and then seeking advice on what your best options are.
Which sort of leads me into a question that has come through, Brett. So, comparing banks at the moment, so which ones are the quickest to turn around any funding or applications, interest rates, all of that sort of stuff? Which banks are better than others at the moment? Can you say?
Oh, it's a bit of a lottery, actually, Justin. We're finding the ASB Bank is turning things around the most quickly for us at the moment. But yeah, other than that, it's a bit of a lottery, and who picks it up and how much pressure you put on them. Yeah, the squeaky wheel gets the oil, as they say. Anyone involved in the mortgage industry at the moment is absolutely slammed with work, and it's pretty tough. So what we're tending to do, and I know what the banks are doing, is that they're looking at scenarios, and they're looking at, okay, what's the time pressure here? Because a lot of people say looking at a refinance and they want to turn around in 2 days' time. It's not a time pressured thing, and it's going to go to the back of the pile. Whereas if we have a finance date on a property, or there's an auction tomorrow, that's going to be given priority. So it's a little bit different for everyone.
Yeah, right. Yeah. So is it a good time to be a mortgage advisor at the moment, mate?
It's a stressful time to be a mortgage advisor, and there's a lot of frustration in our industry right now, Justin. But also, we're helping a lot of people, and we're doing really well in terms of our business. But we're helping a lot of people, and that's the main driver. But yeah, in terms of our day-to-day operation, it's quite a frustrating existence because we need things done really quickly, and everything's happened so slowly. And in normal times, we'd make a request to a bank via an email or a phone message or whatever, and they'd get to it. Now that just goes into an abyss, and you have to keep chasing and chasing and chasing, and it's creating a lot of work for us.
Yeah, right. Yeah, cool. So look, what's that?
Can't complain too much.
No, exactly. So I think I've only got one question really. I've asked a few throughout the webinar, but and I'm not sure whether you'll be able to ask this one either. But what would your advice be to first home buyers right now in this current market? How do they get on the ladder?
Well, I guess the answer to that is there's more than one way to skin a cat, Justin, and there's all sorts of options out there. So firstly, every bank will lend you a very different amount of money per dollar of income that you earn, and the calculations between the banks can be hugely different. There could be hundreds of thousands of difference between Bank A and Bank B. So look at the market. Seek advice. There's a lot of fish hooks to look out for when you're buying properties in New Zealand these days, and you need to make sure that you're doing the right things at the right time. So bring in professionals who know what they're doing, who are very experienced. I think is really important when you're buying your first home. Take the advice that you're getting from friends and family with a grain of salt, because they may have had an experience 6 months or 12 months ago, and things might have been completely different back then. The criteria might have changed. But you really, to get a foot in the market at the moment, you really have to be pre-approved, and that is a tough thing for first home buyers, because if you haven't got your 20% deposit, you're going to need to get a valuation done on whatever property that you buy, and you spend $1,000 on a valuation, you lose the auction. It's a big waste of money. So there's sort of not that much you can do about that. But we're seeing all sorts of things happen, like more and more people are teaming up with friends and family members and jointly buying properties, looking at parental guarantees and all that sort of thing. So there is a lot of options out there. But the other thing that you need to do as well is set yourself up before you make a mortgage application. So take some advice on that. But my top tips, Justin, would be at least 3 months and preferably 6 months before you make a mortgage application to a bank. Make sure that you are keeping your bank accounts really squeaky clean, so you're not missing any payments or anything like that. You're not signing up to Afterpay. Pay off any short-term debt that you've got, and then take a look at how much you can save as well, and make a bit of an estimate. Okay, if I want to buy a property at this level and I'm going to need a mortgage of this much, it's going to cost me this much per week to service that mortgage. You want to make sure that you are saving the difference between what you're paying in rent and what your mortgage costs will be, plus your rates and insurance, for at least a 3-month period before you make your application. And you need to save it regularly. Don't do it one week and not the next. Do it absolutely consistently, week in, week out, for a 3-month period, because then you're showing the bank that you can do it. If you're missing it here and there, it's not good enough, because when you've got a mortgage, you can't miss your payments. Those would be my top tips, I think, Justin.
No, that's very, very good advice. Yeah, very good advice, mate. Really good, really good. So, look, I think unless you've got anything else to add, Brett, I think we'll close it up there. That was a very, very good session, and I thank you very much, Brett. Very good advice and some really good topics there. There are our details, so if you need to contact us, there's our email addresses and phone numbers. So do jot those down if you've got any questions after the fact. Anything else to add, Brett?
No, I think everyone's probably sick of my voice now. So thanks for having me, Justin.
No, that's all good. And I suppose, yeah, we'll keep in touch, and we'll hold you to some of those predictions in due course.
Sounds good.
All right, thanks, guys. We'll talk again soon. Oh, just one last thing. This is recorded, so we'll have this available, and we can send it out to you guys after the fact. And feel free to share it with your friends and colleagues as well if you found it beneficial. Really appreciate it. Okay, talk again soon.
See ya.